question. So you can start. So this is how you are going to do it. You are doing 2 readings. First reading, just read. I'm not going to interrupt you. Now, the second reading, I'll be interrupting you from time to time, Now, what will I be doing? We are going to be interpreting every line item in that before. So that interpretation will help us to understand the question. You understand? We also teach you how to interpret such question in the exam. You understand? So similar things may be given to you in the exam. You know what the examiner is telling you. So that's how I do to help my student to interpret question. So the first reading, I'm not going to interrupt you. Just read from the beginning to the end. When you are starting the second reading, then I will interrupt you from time to time. So you can start.
Okay. Plateau PLC is a Nigerian company that manufactures and sells innovative products. Following favorable market research that costs 4 million naira, PT has developed a new product. It plans to set up a production facility in Kano. Although its board had contemplated setting up the facility in an overseas country, the project will have a life of 4 years. The selling price of the new product will be 5,900 naira per unit, and sales in the first year to December 31st, 2019, as expected to be 120,000 units, increasing by 5% per annum thereafter. Relevant direct labor and material costs are expected to be 3,400 naira per unit, and incremental fixed production costs are expected to be 60 million naira per annum. The selling price and costs are stated in December 31st, 2018 prices and 2018 prices and are expected to increase at the rate of 3% per annum. Research and development costs to December 31st will amount to 25 million naira. Investment in working capital will be 30 million naira on December 31st, 2018, and this will increase in line with sales volumes and inflation. Working capital will be fully recoverable on December 31st, 2022. The company will need to rent a factory during the life of the project. Annual rent of 20 million naira will be payable in advance in December 31st each year and will increase over the life of the project. Plant and machinery will cost 1 billion naira on December 31st, 2018. The plant and machinery is expected to have a resale value of 300 million naira at 31st December 2022 prices. At the end of the project, the plant and machinery will attract 20% reducing balance capital allowance in the year of expenditure and in every subsequent year of ownership by the company, except in the final year when there will be a balancing allowance or charge. Assume a corporate tax rate of 20% per annum in the foreseeable future, and that the tax flows arise in the same year as the cash flows which gave rise to them. The directors are concerned by rumors in the industry of research by a rival company into a much cheaper alternative product. However, the rumors suggest that this research will take another year to complete, and if it's successful, it will take a further year before the alternative product comes to the market. An appropriate weighted average cost of capital for the project is 10% per annum. Required: A. Calculate using money cash flows the NPV of the project on December 31st, 2018, and advise the company whether to proceed with the project or not. B. Calculate and interpret the sensitivity of the project to a change in the annual rent of the factory and then a weighted average cost of capital. C. If the board of PT decide to set up the manufacturing facility overseas, advise the board on how political risks could change the value of the project and how it might limit its efforts. Then D. Discuss briefly 4 real options available to PT in relation to the new project. Thank you.
Thank you very much. So we're actually solving question A. Question A. B is sensitivity analysis. So that one is another question. So we're actually solving question A. So that's what we are going to focus on. That is investment appraisal. That is the NPV. So we are going to now read it again. I will now be interpreting it. Yeah. Abi? Chomzi.
I'm here.
Yeah, I said you can now read it again, like take the second reading. So
Okay.
I will interrupt you from time to time. Okay.
Okay. So Plateau PLC is a Nigerian company.
Sorry. So some people were not in our last class. I will see how we can carry these people along. So let's see.
Okay.
Continue.
Okay. Plateau PLC is a Nigerian company that manufactures and sells innovative products. Following favorable market research that
Hello, is it only for my end? Hello. Hello. Is it for my end? Was interruption from my end?
Yes, it was.
Okay. Continue. So following
Okay, I'm
favorable
starting.
market research that cost 4 million naira,
4 million naira.
that cost 4 million naira. Now, if the goals are given, you need to interpret it. Now, the first thing we started with was to identify whether a cash flow is relevant or irrelevant cash flows. Now, which is the key of this topic? Every topic, see, the truth of the matter is that every subject has a key, so that if you unlock that key, like this SFM now, SFM is anchored on something we call time value of money. You see this concept of time value of money? If you have very good understanding of this concept, SFM becomes a baby. Every subject has something that once you unlock it, the rest is a baby. Now, this topic, it's the same thing with each topic. Each topic has something that if you unlock that thing, the rest becomes a baby. Now, for capital budgeting or investment appraisal, the thing you need to unlock is relevant cash flows. What is relevant? What is not relevant? The moment you understand that, every other thing there is a baby. The key you need to understand is the relevant cash flow. Now we discussed this, that the relevant cash flow has majorly 3 concepts. One, is it in cash form? Like this one now, we look at it, 4 million naira, relevant following favorable market research that cost 4 million naira. Yes, it's in cash flow. It has passed, but it needs to pass the 3 for it to be relevant. It's in cash form. So you can't say, oh, everything that is in cash form, that is so it can be in cash form and still be irrelevant. Then what is the next thing? Is it futuristic? Does it relate to the future? Following favorable market research that cost 4 million naira. Now, when we did our market research, we paid 4 million naira. Now, it relates to the past. It's not relevant. So a cash flow that relates to the past is irrelevant. So now once you cancel it, it makes it irrelevant. You can can take your time to do this in the exam. Briefly and very fast. Although there are some cash flow, you're looking at it, and if you have practiced, and that is what practice does for you, if you have practiced so many questions as possible, honestly, if you practice like about 3-4 questions in each topic that we're going to treat, then you don't have issues in the exam. That's what cash flow you will see. You don't even need to think twice. The moment you read it, you know it's relevant. You know it's relevant. You know it's relevant. Then the next one is incremental. 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 So if you pass this one, fail this one, or pass this one, but because if you fail this one, cannot do pass this one. That's what the simple truth. Once you fail this one, you fail this one. So if you pass this one, but fail this one, then it's not relevant. It's not. So you must pass the 3 to be relevant. So now, following favorable market insight, that cost $4 million. You pass this first one, but you fail the second one, so it is irrelevant. Continue.
Okay, so PT has developed a new product. It plans to set up a production facility in Kano, although its board had contemplated setting up the facility in an overseas country. The project will have a life of 4 years. The selling price of the new product will be 5,900 per unit, and sales in the first year to December 31st, 2019 are expected to be 120,000 units, increasing by 5%.
Okay, increasing by 5%. Now, sales in the first year to December 31st, 2019. Now, this is how examiner will give you question. One, the examiner in this question is using actual year. Now, examiner can use actual year. Examiner can just be using year 1, year 2, year 3. Now, if examiner is using year 1, year 2, that is pretty straightforward and pretty easy. You already know what is year 1. You already know the cash flow in year 1. You already know the cash flow in year 2, cash flow in year 3, and so on. But if examiner is using actual year, you need to be very careful with your cash flows. Now, the first thing you need to do is to identify, you ask yourself, which year is year 0? Which year is year 0? Now, this examiner is very smart by mentioning 2019 first, so that now, first, because he mentioned 2019 first, doesn't mean 2019 is year 0. So now, first thing, how do you identify year 0? To identify year 0, go and look at the year they purchased the assets. Now, the year they purchased the assets, that is when is year 0. So any year they purchase the asset is year 0. You will now start counting year 1 from that year. No, but look at what this examiner did. He said December 2019. Please, can you take this part again? December 2019.
Okay. He said the selling price of the new product will be 5,900 per unit, and sales in the first year of the
first year, and sales
to December
on December 31st, 2019. Now, first, the assumption in capital budget is that all cash flows are occurs at the end of the year. The assumption is that all cash flow occurs at the end of the year. And sales in the first year to December 2019, to December 2019, to December 2019. And sales in the first year to December 2019, to December 2019, is telling you that now, it's telling you December 2019 because that's at the end of the year. So cash flow can occur at the end of the year or beginning of the year. Now, if a cash flow occurs at the end of the year, you put that cash flow in that year. Now, if a cash flow occurs at the beginning, you cannot have middle of the year, so please take note. If a cash flow occurs at the beginning of the year, now this is the rule. If a cash flow occurs, the assumption means all cash flow occurs at the end of the year. But if a cash flow occurs at the beginning of the year, now take it to the end of the previous year. So if it occurs at the beginning of 2019, it means that that cash flow in your capital budget will be at the end of the previous year, which is 2018. If it occurs at the beginning of 2020, that means you will take it to the end of 2019. So a cash flow that occurs at the beginning of a particular year is deemed to have occurred at the end of the previous year. So please take note of that. Take note of that. So now, according to the examiner, he's telling us that this is 29. This is the first year. So we write it down somewhere. We write it down until we confirm. I always tell students, now when you see a statement, you see all these questions they give to you. Now, examiner does not make questions to be too lengthy for nothing. Now, any statement you see in the examination question is there to do three things for you. Number one, is there to give you a whole new information. Number two, is there to confirm an already existing information. Now, a examiner can say something now, we give you another line to confirm what he has said at the beginning or somewhere at the top. So please know that that's what examiner do. And thirdly, some of the statements are there just to confuse you. Examiner, so whether examiner put some things to confuse students, the answer is yes. There are some things the examiner will put there purposely just to put the student into confusion. Now, the answer is yes. Now, and I tell you, some students will be confused with that, and they will be looking at it for 30 minutes in the exam, and that examiner has achieved his purpose, just to waste your time. So you need to know that. So now we'll write it down somewhere that 2019 is our year one. We've not confirmed until we go to the what's it called? Yeah, are you for skills or professional? Eh? Yeah, are you for skills or professional? Professional. Okay, consider. So we are not sure yet until we get to this part. Until we get to this part. Until we get to this part where we get to the part where what's it called? Until we get to the part where investments, the purchase of asset will tell us whether it is year one or year 7. So we know that. So now, that's one. Then that line statement carries a lot of things. And he told us that the sales volume, I mean, that's the one that was used. Okay, he said sales in the first year. Hello? Hello?
Hi.
Now, see, this is a trap. Now, let me show you that. Now, the examiner is supposed to tell you sales volume. Now, the examiner says sales in the first year is 120,000 units. Now, with these units, you should be able to know that it is not sales. It is not like sales value. It is not sales in amount. It is sales volume. What the examiner is giving you is the sales volume. Now, I won't be surprised if this exam, some people pick this as revenue for the sales. But you should know that with this one as examiner use, sales in the first year, you should know with this unit here that it is, examiner is giving you sales volume, except if examiner gives you in naira form, then you know that that is the sales, that's the revenue. But now, this is just the sales volume or the sales unit. So please note that. That is not telling you that this sales unit will be 120,000 in year one, but is expected to grow at the rate of 5%. Now, please note this. There's a difference between if sales volume is growing, that is what we call growth rates. That is growth. That is growth. But if price is growing, that is inflation. Increment in price is inflation, is not growth. But increment in volume is growth. Note that. So continue. Continue.
Okay, so increasing by 5% thereafter, 5% per annum thereafter. Relevant direct labor and material costs are expected to be 3,400 naira per unit.
Relevant direct costs and material are expected to, so examiner has told you that it's relevant. You don't even need to argue it. Well, I don't argue with the examiner. Examiner has told you that it's relevant. Now I'm taking my time to explain this. Now, the more we solve, because this is our first question, the more we solve questions, there are some things I will not explain because I've explained it before. And that is why I expect students to join the class early, because by the time we move forward, people that will join us after, when we start saying all these things, they will be joining us back. So this one is relevant. We don't need to contest it. We don't need to contest it. Continue.
Okay. An incremental fish production costs are expected to be 60 million naira per annum. The selling price.
An incremental fish production costs are expected to be 50 million naira per annum. And so now, let me tell you, when we say, I did not take time to explain incremental. I did not take time to explain incremental. Now, when we say it is incremental, now, please, it does not mean you can say that it's fish cost. If I say fish cost is incremental, it doesn't mean that the fish cost. Now, let me say, a fish cost of 50,000 naira every year can be incremental. Now, you now ask yourself, now 50,000, when we say incremental, that you know the third part I told you is I said it's going to be incremental. Incremental does not mean that, oh, the prices will be increasing or the fixed cost will be increasing. That's not where we are referring to incremental. So look at what we call incremental. So I can have 50,000 naira every year and it's still relevant, and that is incremental. Now you now ask yourself, now what is incremental? So this is incremental. So in capital budgets, let's say we have an existing machine. This was the existing machine. We want to replace it with a proposed machine. This is the proposed machine. We have an existing machine. We want to replace it with a proposed. This is the existing. This is proposed. Now, this one is what existing. This is what they are currently using for production. Now they want to increase it. Let's say this one they are currently using for production. Currently, the fixed cost they incur on it. Sadiq, are you with me? The fixed cost they incur on it is, let's say, 1 million naira. Now, we will now bring in a new machine, and the new machine will increase our fixed cost from 1 million naira to 1.5 million naira. So this is what we call increment. That is, this one will have been spending 1 million naira every year. Now this one will not be spending 1.5 million naira every year. So if I want to appraise this project, what I will look at that is relevant to appraise this project is just the incremental value of the fixed cost, which is what class? What is the incremental value?
500,000.
What?
500,000.
500,000. This is what is relevant. So, but the fixed cost to appraise this project will now be, even though I will be incurring 1 million naira, but the machine I'm replacing it with, I will be incurring 1.5 million naira as fixed cost. The machine I'm replacing it with, I will already be incurring 1 million naira. So, what extra cost that I'm incurring? So, with or without this machine, I will still incur 1 million naira. So, it's not relevant. When I bring in the machine, I don't bring in the machine, I will still incur 1 million naira. So, what I'm incurring as new is the 500,000. That is what we call incremental. Not incremental does not mean it's going to be increasing. Incremental that it means that it's going to increase the cost or the cash flow we are going to be generating or be incurring every year. That's what we call incremental. So please note that. So continue.
Okay, so the incremental fixed production costs are expected to be 60 million naira per annum. The selling price and cost are stated in December 31st, 2018.
Now, in every question, this statement, you must always have it if there's inflation in that question. Now, if there's no inflation, examiner does not need to tell you the prices is stating the prices because it's going to be fixed. It has already given you the price. But if there is inflation, that means the price is expected to grow. Now, the examiner must tell you when he's stating the price. I think I gave an example. I used a very typical example when we were dealing with last week, and I used something that everybody can relate with in class. Like I used bottle of Coca-Cola, and I told you that there was a particular year that the bottle of Coca-Cola was 100 naira. There was another year that the bottle of Coca-Cola was 150. There's another year that the bottle of Coca-Cola was 200. There's another year that the bottle of Coca-Cola was 250. There's another year the bottle of Coca-Cola was 300. And now currently the bottle of Coca-Cola is 500 naira. Now, can I tell you, bottle of Coca-Cola is 300 naira. As that so year prices. That's what the examiner is telling. Now, why is the examiner giving you this information? So that you know when you start applying inflation. And examiner can only state prices as at year 0 or year what? Year 1. It cannot be from year 2. It's either as at year 0 or as at year 1. So if examiners are giving prices as at year 0, it means start applying your inflation rate from year 1. If you are giving your prices as at year 1, start applying your inflation rate from what? Year 2. That's what it means. Continue.
Okay. Set to increase at the rate of 3% per annum. Research and development costs to 31st December will amount to 25 million naira. Investment in working capital will be 30 million naira on December 31st, 2018. And this will increase in line with sales volume and inflation. Working capital will be fully recoverable on December 31st, 2022.
Take that part again.
Which part? Investment in working capital.
Start from after the price are stated as at 2018 prices.
The selling price and cost are stated in December 31st, 2018 prices and are expected to increase at the rate of 3% per annum.
So all the prices are expected to increase by 3%. And don't forget that volume is increasing by 5%. Don't forget this. Volume is increasing. So all our prices, both cost and selling price, are increasing by 3%. So notice that continue.
Okay. Research and development costs to 31st December will amount to 25 million naira. Investments in working capital.
Continue.
Is not relevant. Investment in working capital. Investment in working capital will be 30 million naira in December 31st, 2018. And this will increase in line with sales volume and inflation.
Increase in line with sales volume and inflation. See, I always tell people, see, whether we like it or not, I'm going to tell you the simple truth. I'm going to tell you the simple truth. A lot of people complain of SFM, and I tell people that one of the things that make SFM to be difficult is because of its concepts. It draws concept from a large number of subjects. Number one, it draws concept from mathematics. It draws concept from statistics. It draws concept from economics. Then it's general concept, which is the core finance. Now, whether you like it or not, sometimes when students approach me with questions and say they're having issue, and I tell them, oh, this issue you're having is not, the problem is not coming from SFM itself. The problem is the foundational problem. Foundation is that there are some foundational things you should have understand by now that you need to apply in that question. That is what is giving you issue. Now look at this question. The examiner says that working capital, WC, we increase in line with sales. Now, that means before now, you should have understanding of how you apply increments on 2 rates. When something is increasing by 2 rates, that now it's increasing by 3%, which is inflation rate increasing by what? 5%. Increasing by 3%, increasing by 4%. Now, don't forget, now we do, if I want to increase something by just 1 rate, I will do 1 plus I1. Let's say I1. Let me say it's increasing by inflation and growth rates. Let's say I is power N. Then I was multiplying by the growth rate, 1 plus G is power. This one stands for the growth, which is 5%. This one stands for I, which is what inflation rate, 3%. So if I'm doing year 1, this will be what I will use. If I'm doing year 2, this will be what I will use. If I'm doing year 3, this will be what I will use. So you must do it that way. So which means if I do 1.03 bracket 1.05, 1.03 bracket 1.05. Good morning. Are you for skills or professional? 1.03, 1.05. So if I now multiply this, let's now say both of them for year 1. If I multiply this, so 1.03, 1.05. So it becomes what? 1.0815. Now, which means this is what I'm going to be using to increase my increase. So I can use this 1.0815 for year 1, 1.0815 for year 2, 1.0815 for year 3, and so on, depending on the number of years. That's what you are expected to apply in working capital. Is that clear? Is that clear?
Yes.
Okay, continue.
Okay. So working capital will be fully recoverable on December 31st, 2022. The company will need to rent a factory during the life of the project. Annual rent of 20 million naira will be payable in advance on December 31st each year and will not increase over the life of the project. Plant and machinery will cost 1 billion naira on 31st December 2018. The plant and machinery is expected
will cost 1 billion naira on December 31st. December 31st, 2018. Don't forget, I told you that is the year. If I give you natural year, if an examiner is giving you just year 1 year, 2 years, the examiner will tell you, this is how you know if it's actual year. So plant and machinery will be purchased now, immediately. Now, in capital budget or investment appraisal means year 0. Please note that. Now, immediately means year 0. Means year 0. So anything that is happening immediately or any cash flow, they tell you that a cash flow will be done immediately. Please take it to year 0. It means that cash flow is in year 0. So now the examiner now told you that 2018, which means that it has confirmed. Don't forget, I told you that some statements are there to confirm an already existing information. We have this already, but we have not confirmed it. You are going to be seeing so many statements like that when we start solving questions. That there's some statement examiner will just give you. It's just to confirm what you have. So to confirm an already existing information. So 2018. Now with this, those kind of statements, when you have confirmation statement, it gives you confidence, it boosts your confidence. If I'm shaking up, but I've been thinking, is this year 1? Is this year 1? Is this year? With this statement, it boosts my confidence. Okay. Now I will not have that confidence to use this as year 1, since I've confirmed this to be what? Year 0. So continue.
Okay. The plant and machinery is expected to have a reserve value of 300 million naira at December 31st, 2022 prices. At the end of the project, the plant and machinery will attract 20% capital allowance, that is in reducing balance, in the year of expenditure and in every subsequent year.
We have done how to calculate capital allowance. So what we have done how to calculate capital allowance. So we learned how to calculate capital allowance using reducing balance method, using what's it called? Straight line method. Now, if the examiner give you straight line method, that's pretty straightforward. Good. But if the examiner give you reducing balance method, that means you need to calculate it. So although we are going to calculate it, so for those of us that missed that last class, we will now learn how to calculate it here. So continue. And examiner will always tell you the timing of cash flow as well. Continue.
Yes. Okay. And in every subsequent year of ownership by the company, except in the final year when there will be a balancing allowance or charge.
Now, look at this statement. Now, sometimes you'll be wondering, so I always tell students, if you are calculating your capital allowance, only start from year 0. But there have been some cases where examiner will ask you to start from, sorry, let me take that statement for the purpose of those that have been watching the video. That's an error. If you are calculating your capital allowance, only start from year 1, not year 0. Only start from year 1. Now, but there have been some instances where the examiner will require you to start from year 0. Now, in those instances, just like this, the examiner says that the capital allowance will attract a reducing balance of 25%, including the year of acquisition. Now, the year of acquisition is 2018, which means start from year 0, including the year of acquisition. Please, that is, so if we start from year 0 now, it doesn't mean if you start from year 0 in this question, now you want to solve another question. That's why if I'm solving something that is going to be given for subsequent question we are going to do, I'm going to emphasize on it so that you will see, oh, we solve this, why are we solving this one separately? Now, examiner is the key in every, always tell my students, please always follow examiner. So if I teach you something and examiner say this is what I want you to do, please follow examiner instruction. Examiner is the king as far as that question is concerned. Follow the examiner's instruction. Whatever the examiner says you should do. So don't argue with the examiner. Oh, this is what my teacher taught me. This is what my teacher said. Now, your teacher is not the examiner. Your teacher taught you this is the way they do it. But if the examiner does say, I don't want to follow it this way, I want you to do it this way, then follow the examiner's instruction. So normally, you start from year 1, but examiner can require you to start from what? Year 0. Now, if that is the case, follow the examiner's instruction. Now, do it the way the examiner wants it. But don't forget, it is always in year one, except stated otherwise. Continue.
Assume a corporate tax rate of 20% per annum. The foreseeable future and that tax flows arise in the same year as the cash flows which gave rise to them.
That's actually a
The
bit. That's what put them in the same year.
The directors are concerned by rumors in the industry of research by a rival company into a much cheaper alternative product. However, the rumors suggest that this research will take another year to complete, and if it is successful, it will take a further year before the alternative product comes onto the market. An appropriate average supply.
Now that part I explained it. That area I explained what it means. Let me just quickly do a recap on that. I explained what it means. We call it cannibalization. It has never been tested in ICAN exam. Now, that area is seen as an advanced investment appraiser. It can never be tested in the previous, but now that you have advanced investment appraiser, that means you are expected to have question on cannibalization. Now, we are going to take areas of cannibalization. That means in our next class that we are going to be looking a little bit advanced investment appraiser. So we're going to go beyond what has been tested in the past. Let's go beyond. And one of the areas we are going to be looking at is cannibalization. How do you factor in cannibalization into our project? I tell you, fact, is a very complex thing to do. But let me just explain to you what it simply means. Now, you forget that this is PMP, a nutrition house, and there's a center here. You know that it is when people start seeing demand, you start seeing some vendors. Now, let's say, for instance, there's no food vendor here. Maybe there's one woman that does something else, and just everybody come to ask her, where do I get food here? She noticed that every student comes to ask her, where do I get food? That's if I start selling food here, I'm going to sell it. But first, let me do my appraisal. Let me see whether this is a good business venture. Now you look at, he come to meet the directors. Please, how many students you have, physical students you have in each class? It's okay, the physical student you have in each class, it's okay. In foundation, we have 20. In skills, we have 40. In professional, we have 15. Now she totals it. And so, okay, this is 5, this becomes 75. Now this will become his units that what is going to use as number of students to determine how much he's going to sell. So you know use 75 people as that's what that area is telling you. So that you understand what the examiner is telling you in that area, or what those people are looking at in that area. You use 75, and the thing is saying, good investments, accept the project, go ahead and do the project. Now, cannibalization, you don't forget that you are not the only one that is thinking that food business is a good venture. As you are thinking, other people are thinking. Now you have started it. You have this 75. Don't forget that the moment other people look at it as a good business venture, they begin to come into it. They will share the 75 people with you. I mean, you are not the only one that will sell food to them. Now, but you are doing 75 to do your competition to say accept the project. What if these people share a portion from you? Now, how many portion? What portion are you going to lose out? That's the cannibalization. What portion are you going to lose out to others competitors? You understand? So what market share are you taking out of this 75? So you need to factor in. If I assume out of this 75, no, but this person comes, this person. It's a very difficult thing to do, even in real life. It's a very difficult thing to do. But I'm just giving you theoretical what it simply means. Now, if I ask, okay, in this 75, I'm going to take bad as a bad, and take 70%. What's come to worst case scenario? I will get my 70% market share. Then I will now reduce this one to 70% market share and see whether I will get a positive MPV. So that's what they are looking at. That in the next, before those people will come in, we would have used so years in the market, or it will take so amount of years. That's what that area will be. So, but we're going to look at questions that. So now it's now time to solve. So the first thing you do, check if you are giving sales volume. So you follow it in this order. If you are giving sales volume, you follow it in that format I gave you. The first thing I gave you is revenue. And don't forget, you cannot have revenue. This is how you calculate your revenue. Your revenue is equals to your what? Selling price times units. This is how you calculate your revenue. Now, for you to calculate, first thing I will not check. Do I have the units? Some question examiner will give you the unit for the whole year. Now, if you have it, just go ahead to calculate your revenue. That means multiply your selling price by your unit. But don't forget to factor in your inflation according to years. You have a question? Okay, what's your question? Okay. It's because you came in. May 2018 quiz. Are you on the group? Are you on the SFM group? And check. They sent it this morning. So go and check. The question is on the group. I think it's the first thing that is sent this morning. So, I mean, the first for picture, something that was sent. Okay, I think I've sent. But you see a question. So now, but in this question, we don't have the unit. So we need to calculate the unit. So how do we calculate the unit? So we come here. Unit, or sales volume. So now workings. Everything we are doing now is workings. So let's start with workings. Please don't forget, you leave a space for your main investment proposal. You do your workings at the bottom. So, but this is the top. So workings, we have sales volume. So sales volume. So we have how many years? Yeah, 2019 is our year 1. 2020 is our year 2. 2023, 21, and 2022. I mean, is it not for 4 years? Class? Is it not for 4 years?
It's correct. It's correct.
Yes, it is, sir.
2018. So there's no way you can have sales volume for 2018 because yes. So sales volume, our sales volume started in 2019, 2020, and 2022. I want to ask a question. Now, to be sure that you guys are following, when will I start applying the growth rate? Is it from 2019 or 2020? Marker. Okay, are you serious? Then I want. So you just engage the physical people.
2020.
So 2020.
Can you please ask somebody? Hold on to one. Okay. Yeah, I'm with you. What do you say?
2020.
2020. Thank you very much. Because the volume that was given, so we say volume. First, let me write the growth rate first. So growth rates. So growth rates. We start from 20. So we have 5%. 5%. So if you start from 2020, I want to do something. So we have applied this formula. Our sales volume. Apply this formula. 120,000 bracket 1.05 is per n minus 1. Apply that formula. $120,000 bracket 1.05. These are sales volume. I hope I'm not outside the range. Sales volume. 120,000 bracket 1.05 is power n minus 1. Now, ask me any question. Ask me any question. Question can be as regarding the formula. Ask me any question. Any question.
Are you there?
Oh yeah, now, do you understand what I wrote? So if you understand this formula I wrote, you know I wrote this in n minus 1, and I did not use n. You understand why I use n minus 1 and I did not use n? Or you are still studying, what are you doing? Let me know. Is this talking about now? Hello, can you hear me? Can you hear me?
Yes, yes. Can hear you.
Yeah, but I'm asking a question and nobody's answering me now. No, nobody's answering me now. So you're all saying you can hear.
Yes, I can hear you.
So you understand what I did. So fine, continue. Should I move forward? Okay. Sir, no problem with it. Just continue. That's my question.
Please explain further, sir.
Okay. So now, you know that normally if I want to increase something, I'm just supposed to say, okay, that thing, let's say 50,000 bracket 1.05 base power 1, base power n, abi? So if in year 1 I put 1, abi? In year 2 I put 2, abi? Isn't it? You can agree with me. You agree with me, right? Now, so if you look at this already, if your year 1, if your inflation, you can do this as well for inflation. Now let me give you the key. So take note of this. If you expected to start increasing your inflation from year 2, use n minus 1. If you expected to start increasing your inflation from year 1, use n. That's not the simple logic. If you expected to start doing your inflation from, apply this formula, do this formula, but if your inflation will start to increase from year 2, do n minus 1. That means we are saying that minus 1 year, that minus the first year. You understand? Do n minus 1. When the inflation will start to increase from year 1, just do raise power n. Is that taking right? Is that taken? Class.
Yes.
Now, so if I do this, so point on your calculator, I want to do for year 1. Don't forget that 2019 is year 1. 2022 is year 2. 2023 is year 3. And 2023 is year 4. If I do for 2019, although SFM has given us the figure, but I want to show you the trick. SFM has given us the figure that our sales volume will be 120,000. Let's see whether we'll see arrive at 120,000. If for year 1, I put 1 here, it becomes 1 minus 1. 1 minus 1 is what? 1 minus 1 is what?
1 minus 1 is 0.
0. Now, it now becomes 1.05 raised per 0. What will it give you? 1.05 raised per 0. What will it? 1. Note this. Anything raised to power 0 must equal 1. Anything, no matter how big the figure is. If you like, let it be 1 billion. Let it be 2 billion. Raised to power 1. The moment it's raised to power 0, introduce it to 1. So 1.05 raised per 0 gives you 1. 1 times 120,000, retain your 120,000 here. Now, give me the value, give me the remaining values now. Give me for this, give me for this, give me for this class. Give me values. So for 2020, that becomes here, n becomes 2. For 2021, n becomes 3, and so on. Give me value. Give me value. Give me value.
Hello, sir.
I'm
136.
Did we do -1 for the year 2019? Did we? Is it n minus 1?
Yes, sir, n minus 1. That's the formula I using generally. N minus 1. And I told you the reason. Because we are starting the growth rate from year 2. If I started it from year 1, it becomes 1. It's just a minute.